Good morning, everyone, and welcome to Weekly Profit Talk. And welcome to the month of March. Hope everybody's doing incredibly well today. I know it's been a little bit of a strange spring wherever you are in the country. Snow out east, or absolutely no moisture at all here in the Rocky Mountains where we are. Well, anyway, good morning. We This is Weekly Profit Talk, which means we do this every single week. Uh, that time is 8:30 a.m. every single Wednesday. That is 7:30 if you're on the West Coast, 10:30 if you're out there in the East Coast. So, good morning and welcome once again. Our topic today is doctors, what your tax return is trying to tell you. There's important information with this thing. Um, let's just say, and I'm going to give you a little bit of an allegory here. Um, if you looked at a patient's lab panel and just kind of checked the bottom line number and without reading it comprehensively, you're not getting the whole picture. And the thing of it is that document that you just completed, whether or not you did it yourself or had professional help, um, it's telling you quite a bit more than just what you owe and how frustrated you should be with the IRS. There's a lot of information in it, and let's see if I can share some insights with you that'll actually help you manage the stress of being in business for yourself. So let's go ahead and I'm going to begin here by saying the first thing is that, and you're probably painfully aware of this if you uh, do insurance collections at all. You may have your primary, secondary, and even tertiary insurances, as well as co-insurance and co-pays. So the chances are that when you bill for a data service, um, you basically have a retail amount at one end, but as this says, your return's only going to show the money that actually hit your bank account in 2025. For your dates of service in mid to late December, um, chances are, matter of fact, you may still have claims out there even now, though I hope it's getting close to 90 days. We don't want that if you can help it. Um, obviously, my best feeling on that is you really should have a 65-day average, with hopefully most of them with a primary insurance as being under 2 months. So hopefully you've got your 2025 paid by now. But here's the point, and this is important, is that and if you're a practice that's making under $10 million, and this is kind of an average, or uh, basically you are not hospital related, in other words, you're working as a private practice for yourself, chances are you're using the cash basis method of accounting, and you should be. There are two different methods. The other one is accrual. Accrual is basically recommended by the Healthcare Financial Management Association as the preferred method for large-scale operations like hospitals. Basically, you count revenue when you do the billing, whether or not you receive the cash. So, also the same thing as the opposite side of that is that when you basically bill for an expense and you bill a vendor, if they've got a net 15 or net 30, you're basically counting the expense at the time that you send the bill. But cash basis is just what it sounds like. You count money when it actually hits your palm, and also your expenses are basically counted when the money goes out of your bank as well. So revenue versus collections is kind of a gray area. Now, you will hope that over the course of several years, this is going to strike a bit of an average. So, but the main thing to keep in mind is that your tax return is telling you the amount of money that you actually made in 2025. So, I imagine those could be billings as far back as November of 2024, all the way until, say, around Thanksgiving of last year, because on average, most of your receivables aren't going to pay within a month or so, unless you get that rare unicorn and somebody actually pays in cash in full. And there are some practices that do that. I actually receive a level of health care from someone that deals only in cash because most insurances won't pay for it, but it's kind of a therapy that insurances believe is not necessary and ordinary. Um, I disagree with them, but I can't do anything about that. So, but any event, your return won't diagnose the cause of why your collections are outstanding, but it will absolutely flag the symptom, and it's important to keep that in mind. So, Next thing is your overhead ratio. Now, you may have heard of something called profit margin. Your overhead ratio is basically the same thing, but looked at from the other side. So, deductions divided by the amount of revenue. And deductions is basically all of your costs of doing business. You're going to have costs of goods sold. Your biggest um, expense that you're going to have in a practice, if you have more than a couple of medical professionals assisting you, is going to be staffing. You've got to have somebody making the appointments. You've got to have other people seeing your patients at various levels, nurse practitioners, that kind of thing. So, staffing is far and away the number one expense for a medical practice that has at least several people working for it. But you have many other things. And I can think of a few. Malpractice insurance. What about supplies? Got a lot of consumables. Rent. I would say the vast majority of practices are actually leasing the space that they practice in. Sometimes, and this is an ideal scenario for you to be in if you can get there, is that you may invest in commercial property within which you can run your practice. Now, what you want to do is create a holding company or corporation for um, that real estate holding, that commercial holding, and basically pay rent to it out of your practice. So you're basically in charge of two different companies that way. It's actually the best way to do that for a number of reasons. So, um, but you're paying for a number of other things, legal and professional, including people like me, accountants, lawyers, that kind of thing. If you have malpractice and you're running a medical practice, sooner or later, um, you may find yourself in a situation where you need the legal system. So these are all overheads, and that is basically what we mean when we say the word deductions. That's kind of a catch-all phrase. It'd be the cost of goods sold plus all the expenses of administrative and selling, marketing, et cetera. So um, if you divide the amount of all of your expenses by your revenue, you're going to come up with an overhead ratio. So industry benchmarks, most specialties land somewhere in the 60 to 65% area. If you do the reverse of that, or antithesis, as it were, then you're talking about a 35 to 40% profit margin. That's a pretty good place to be in, actually. If you if your return shows that you're creeping up over 70%, um, that's a warning flag, and it's something that you need to be taking a look at. Rising overhead on flat revenue is a slow bleed. You can see the obvious reasons why. You're basically making the same amount of money but spending more. That is basically death by a thousand cuts, a small cash hemorrhage. You won't feel it unless it's a crisis, but when the return shows it right now, then you have an idea that you can do something about it before it gets completely out of hand. Another thing that your return should be providing you is a balanced ratio between the compensation you take from your S corporation um, versus the amount of money that you're making in net income and what you take in distributions. And these are three different things, and they all deserve a little bit of examination. So, first of all, if you are making, and I'm going to say, if you have professional accounting and legal help in your business, um, I'm going to say you're going to want to be making $80,000 a year the first year that you become an S corporation with an eye on growth and scaling that practice. Uh, the reason being is that over time, especially if in your second or third year, um, you expect your practice to grow somewhat as you get more good word of mouth, more 4 and 5 star Google reviews, that kind of thing. The practice should grow and basically take care of the attrition that you're going to eventually have. People will move out of town, even if they continue to love you and you don't lose people for other reasons. Attrition is natural. There's a little bit of churn in any business, but if you continue to bring new people in at a rate greater than the rate at which you lose them, your business will scale, especially if you keep pace with a certain degree of your UCR rates as well as the rate of inflation. So, having said that, if you are making over $80,000 and you file that as a attachment to your 1040 on what they call Schedule C, it's a business income attachment, that's going to automatically create another schedule called Schedule SE, which is short for self-employment. You will pay both the employer and the employee side of Medicare and Social Security tax if you're a sole proprietor. So what you want to do at this 80 to $100,000 in scaling point is strongly consider electing the S corporation taxation. What this will do is you basically flow through um, an S corporation tax filing, which will create a Schedule K1 with net income. But for you to be able to do that properly, the IRS does expect you to take a W-2 wage and to pay yourself a wage first out of your business. What's reasonable compensation? Uh, don't believe I don't have that phrase here, but bury that in your head. Reasonable compensation is basically the lesser of the amount it would take to replace you in your practice competently, or somewhere around 45 to 50% of the total amount of net income that you take in. You want your wage to be somewhere in that area. Now, what that will do is it will create a W-2 for you. Um, and just like any W-2, you'll be an employee of your own S corporation. You'll have federal, and if you're in one of the 41 states with the state income tax, you'll be doing your state income tax withholding as well. And so you'll have some payments going in toward um, your withholdings for the end of the year. What's left over after you take your reasonable compensation and all of those other overheads that we were talking about at 60 to 65%, hopefully, at the bottom line, you have something called net income. You pay tax on that net income amount. But let's say, for example, that you're in a $250,000 practice and you're paying yourself $120,000 or $10,000 a month. So the $130,000 that's left over as net income, you will pay ordinary income tax on that, but you will not pay FICA tax. And FICA tax on that amount, I could actually do that math. You're looking at somewhere in the range of, and I'm going to say, well, it would be 14,130 on 100,000. So just add another third to that. And we're talking about, sorry, the mental math's a little slow. You could be saving yourself about 18 to $19,000 in tax that you don't have to pay. But being an S corporation is a delicate balance. You have to pay yourself a reasonable compensation first. And the other thing is, and we mentioned here shareholder distributions. So what is that? And what does that have to do with net income? Well, it's very important that you don't draw more money out of your business than you make in a calendar year in net income. That has to be watched on a monthly basis. And your tax return will tell you how you did with that. If you, for example, made that $130,000, but you drew 150,000 out, then you have what's known as excess distributions. And if you did not have enough shareholder basis in your company, at the beginning of the year to cover that $20,000, you could actually pay more tax on it. So the idea behind distributions is you need to do this on a monthly basis and draw out the amount of money that your business will support to ensure that you're not overdrawing in distributions month by month. And the end of the year is going to give you the final scorecard. So that's basically like the statistics after the ninth inning in a baseball game. So um, if you And as it says here, if you do take too high a wage, you're paying more than payroll tax necessary. That's something that you don't want to do. That will look good, but the thing is, you don't want to pay more FICA tax than you actually have to. But you definitely, and this is where people go wrong, is they'll get stuck on a number and say, "Well, I'm just going to pay myself 60,000." That's reasonable. But if you're making $500,000 a year, the IRS could take you to tax court, and you're probably going to lose your case. in which case you're going to pay all of the money that they believe that you should have paid FICA tax on in Social Security and Medicare taxes, plus interest and penalties as basically a consequence of losing that tax court case. So you don't want to invite that kind of audit. Now, you may have friends that tell you that it hardly ever happens. Also, the IRS is understaffed. They've been laying IRS people off since the new administration came into office last year and everything. Okay, all that's fine and dandy, but do you really want to take that chance? I wouldn't, and I'm not going to let you do it either if I work for you. So your compensation should evolve as your practice evolves. That's the main thing. And you get to the point where your practice is actually making $500,000, then you can pay yourself a reasonable compensation that is the amount of money that a doctor in your profession would make were they to replace you in your position. If that amount is $180,000, then you're keeping 320K, only paying ordinary income tax on that, no Medicare. The Social Security tax income limit ceilings out. I think it's going to be 181,000 in 2026, but you pay Medicare tax on any amount of money, so that continues to accrue. So with that, I hope you find this information helpful. Main thing is your tax return is a measure of your metrics for your past year's performance, and you should look forward to it as such. If you've been paying your estimated tax payments as you should be, then you shouldn't be dreading tax time because you've basically already paid your taxes, and your tax return should reflect a balance due of less than $1,000 or maybe even a small refund. So, if you're doing everything right, then life is good, and you look forward to tax season. I promise you, I've got over 20 people that I'm working for, and they're enjoying that same situation. So, if you'd like to talk about being one of those people at some point, we're on one of three media here: YouTube, LinkedIn, and Facebook, and they all have a comment section in common where you can give us the thumbs up if you would, and say help or more information or let's talk. We'll get back to you within 24 hours, and I'll show you. We'll give you a link to provide you an opportunity to have a free 45-minute conversation with me to discover if working with each other would resonate. So let's do that sometime soon if you'd like. So happy March, everyone. I hope you're having an amazing Wednesday so far, and have a great rest of your day. If you do have a chance, do something randomly kind for a stranger today. So until next week, so long, and we will see you next Wednesday.